accept the video. We're trying to turn on your video.
Yep.
Are you on? Okay, I just invited you to video. If you want to accept it.
There's no exception.
Just go to the bottom left.
Okay, now I can do. No, it says show settings.
Okay, let me try again. Invite you. Victoria, you want to try to invite Yida to video?
I invited him.
There you are. Okay. Welcome everybody to Crypto Defined. My name is Kathy Chu. I'm a former Wall Street Journal and USA Today reporter. And I'm your host for this interview series called Crypto Defined, where we look at the innovators, the disruptors, and the skeptics of the nearly $1 trillion crypto industry. Crypto Defined is produced by TruthDAO, which is a new journalism organization within a DAO. We aim to be non-biased and nonpartisan. You can visit us at truthdao.xyz. Please join our Discord and Telegram communities. Today's guests are Maja Vujinovic, the CEO of O Group, and Yida Gao, the founder of early stage VC firm Shima Capital. Maja and Yida will shed light on the VC industry and its interest in crypto. Why firms invested in FTX despite red flags, falling valuations in the crypto industry, how due diligence is changing, and where they see the most promise over the next few years. Ms. Vujinovic is a thought leader in the crypto space, a pioneer in mobile payments in emerging markets, and an investor in 50 plus companies in the digital asset space, including the reserve stablecoin ecosystem. She's also the former CIO of emerging technology at GE. Mr. Gao is a Forbes 30 under 30, an instructor in crypto finance at MIT, and the founder of VC firm Shima Capital, which has backed investments in Web3 gaming and infrastructure, among other areas. Shima Capital itself is backed by a wave of prominent names, including actress Gal Gadot, investor Bill Ackman, and Amoka Brands and OKX, among other things, among other firms. Thank you both for being here today. I really appreciate it.
Thank you for having us.
Yeah, thank you for having us, Kathy.
I'm sure I butchered one or more names in that list there, so I apologize. So this is a very important topic, Maja and Yida, and I was thinking about this and thinking angel investors like you, Maja, and VC firms such as yours, Yida, are often seen as on the cutting edge of trends in an industry. In crypto, for instance, you both have made investments in companies that you believe will be the leaders of tomorrow, and you often do so with more information and analysis than the average investor has, or at least I hope you do. You can talk to us about that process. Which brings me to my first question for both of you. I think with what's happened with FTX and the crypto firm collapses over the past few months, it's at the forefront of everyone's minds. Many prominent names in the VC world, including BlackRock, Paradigm, Sequoia, and the Ontario Pension Fund, invested in FTX. And we now know that FTX's books were a wreck behind the scenes. So help me to understand here, how did this happen? And is it typical in the VC world to invest in a buzzy firm like FTX without having all the details? Maja, I will start with you.
Yeah, sure. Thank you again for having me, Kathy. This is wonderful. Look, I mean, there are a number of speculations that we know, right? There are lots of also conspiracy theories. Some of them, it'll just be a matter of time if, whatever comes out to be true. Everything from, some regulators being involved from the beginning to kind of, even Deltex and Tether being closely tied in, and how all of this could have been done much better, right? And to your question, a lot of these VCs have been privy to a lot of the detailed information. I think what we just over assume a lot of times, we give a lot of credit to the VCs, is that a lot of them might be as due diligent as I would be, for example, as an angel investor, or as a smaller, let's say, a successful firm as Shima is, right? And that is looking to build a reputation, or looking to build a reputation, looking to grow. And I think it's maybe we are lucky, both of us, I think, in this sense, that we've come into the space way earlier from kind of our fundamentals and the way we've kind of looked at projects going on and investing in. And I think one of the things when I look at Tiger and Sequoia and a lot of these firms investing, I think, unfortunately, there were a lot of things that I still question. There are a lot of things I question even on the Capitol Hill when they were, when they were questioning the corporates around doing due diligence. Why wouldn't they question the VCs and said, hey, can you show us the actual due diligence that you did on FTX? Could you actually point us to the document that shows to us what you actually due diligence, how you due diligence it? And also, did you ask even a basic question of where are you headquartered, right? Because the obvious answer for Sam and everybody else was we're headquartered in Metaverse. Wouldn't that be a red flag to begin with? So I think 1 and 1 here doesn't equal 2. There are some basic things that we're missing is this due diligence that makes me question the stability of some of the largest VCs in the space.
Okay, and Yida, going to Maya's point, I mean, some of the firms have released statements after the fact. Some of the VC firms have released statements saying, I think one of them said that they did their due diligence. None of them that I've seen have really gone into details, going to Maya's point, about what exactly they did in terms of due diligence. I mean, my question is, did they even check the balance sheets of FTX? I mean, what is your sense of what happened? And I do want to go into both of your due diligence process, but right now I just want to understand from your point of view, since you are close to this industry, you're in the industry. I mean, did they even ask for balance sheets here for FTX? How could this happen on such a massive scale?
Yeah, Kathy, and again, thank you for the opportunity to be on your show, and thank you for the viewers for joining in. I think this was a kind of imbalance between supply and demand, and this industry is also one that is super new. So it's not a traditional SaaS company where a red flag automatically goes off if you cannot, do your diligence in terms of reviewing financials, especially for a growth stage company like FTX. But it's a matter of supply and demand, right? There was very few companies like FTX growing at the pace that's growing, that investors who were hungry to deploy massive amounts of capital into the new Web3 space could deploy capital into. So you kind of had to take what Sam and the team said with a grain of salt, and also just do diligence based on publicly available information, based on a lot of the branding that they had around the world, based on the growth that you saw by going to their exchange, and the high level of diligence, financials, and investor deck that they sent around. And not every single firm decided to do the deal. Not every single firm had the opportunity to. But I think what SBF did very well was what I consider the red velvet rope strategy, where you put up a red velvet rope and say, hey, everything is amazing inside. There's a big party. If you want to get in, then these are the terms. And because the supply was very limited and there was a lot of demand, some investors took that bet. And the other, I think, reason why folks that very smart investors decided to invest into this firm is that it's typically the companies that look a little bit different, founders that act a little bit different that achieve the massive returns. So I think these investors put a blind eye to some of the more traditional, typical diligence items that they would check for, assume that they were there, and really were just kind of bright-eyed and chasing that shiny object of FTX. So I think that's kind of what happened. All these firms that you mentioned are fine. There was a small percentage of their total AUM, and sometimes you do have to take those those types of investments in order to return funds.
Just one thing to add there, Kathy, if I may. I think Yida brings up a really good point where I've seen a lot in meetings, and I'm sure he has too. A lot of these younger founders in crypto tend to come into a room, speak fast. They speak terminology, right, that Yida and I will really quickly understand, but you can tell the blank faces of, folks that are a bit older or in traditional finance, and they tend to act in a certain way, and they, for a minute, can make you feel like you're missing on a boat, right? Or you're missing on this train, fast moving train, and you better just invest in us because we'll make the money. I think just when folks work with folks like us in O Group or with Shima Capital, right? We tend to take it slower because we've been part of all of that from the beginning. All the ICOs, I've trained myself in it. So when somebody comes in with the slick language, and very quickly will kind of disregard the fast talking, the slick language, the terms, using terms like there's no risk here. That to me is a massive red flag. And then when I see enormous amount of money being made overnight, right, that's an enormous flag. Not anything brilliant about the founder actually at all. It doesn't impress me really quickly. And I think now on really interestingly, I think a lot of folks now looking at distressed assets can't trust what really is on the FTX balance sheet, right? Because it was so convoluted. So I think even that plays a role, right? When people wanted to do the due diligence, it was so convoluted that you didn't know what was true, what was false.
Right. And I can't believe we actually have to, this would be even a question, but given FTX, Yida and Maja, can you tell me the steps you normally take as a VC firm or as an angel investor in vetting an investment? I mean, what are the basics? Like, I would think one of the basic things would be you have to get their balance sheet. You have to get their balance sheet. As Maja mentioned, you have to figure out where they're headquartered. So take me through one or two important steps that Yida, you go through when you look at your gaming companies or infrastructure investments, and Maja, what are the two important steps, initial things you do? And also, did FTX approach either of you guys, and did you reject them?
Sure. So we had a chance to invest into FTT, which is the FTX token, when they were first raising, I think in 2017, 18. We ended up not doing that seed round just because of the inherent conflict of interest of a hedge fund trading prop shop Alameda starting their own exchange. But the price we could have gotten at was I think 20 cents. So would have been a good investment.
You thought that was a conflict of interest, Yida? So you thought this is a conflict of interest, we're not investing?
Yeah. I mean, in hindsight, the investment, what are you there for as a manager, right? You want to make return for your LPs, and the price of FTT went up very, very. I don't know, maybe $100+, and we would have made good money, but I think inherently we decided to pass on the deal because of the inherent conflict of interest early on in FTX's life cycle.
Okay, and tell me one or two important steps you look at when you're evaluating. You recently invested in Midnight, a gaming company I saw that was this December. So what are the basic steps you go through before you even continue the conversation with these companies? What are you looking for initially?
Yeah. So there are a couple of variables, right? When you're looking to due diligence on a company, and I'll just speak about this really quickly. In the FTX example, it's hindsight 2020, but at the time it was a bull market. You didn't have that much time. That factor was very limited for investors, and it was a very hot deal. And so it usually takes time for companies to turn diligence that you provide diligence lists and requests that you ask for of them. But typically, especially now in a bear market, you have more time to due diligence. Typically, we take probably, I would say, 4 to 6 weeks, maybe 8 sometimes, to due diligence on the company on average. And a couple of steps that we do, yes, we have a first initial diligence call with them, screening call, and if it looks good, then we'll ask them to fill out a diligence request list, which is usually 1 or 2 pages that covers different categories that you'd be interested in as an investor, from product to team to basic financials, cap table, go-to-market strategy, etc. But it also depends on the amount of diligence you can do, also depends on the stage of a company that you're investing into. We typically focus on seed and pre-seed. We want to be the first institutional check into Web3 founders, companies. So there's less diligence you can do as a seed investor versus a growth stage investor who is looking at FTX. But those are a couple of the items that we look at.
Right. And Maja, do you want to join in here? So did FTX approach you? And if so, why did you invest, or why did you not invest? And in general, what are the top 2 things you look for when you're investing as an angel investor?
Yeah, look, I'm always a lot more, as they say, don't ever invest your money, invest somebody else's money. So Yida is definitely smarter than I am here. But although I am an LP in Shima Capital, but I've invested only my money. So I have been tons more careful with my investments. And we really haven't, for me, that was very basic. I've been in the space since 2010. I've launched the blockchain at GE 2014, right? I've invited every single founder in a space to test those smart contracts. I've been part of these ICOs. I've seen what's happening. So for me, when I met Sam, to me, was a simply question of a character. And I know that a lot of folks that have a particular list that they do, those are fine. I follow that list as well of processes, but I first start with my own intuition. I've 17 years of experience of building companies in very tough markets of Latin America and Africa, which it's not an Excel spreadsheet. It doesn't work on Excel spreadsheet. You need emotional intelligence. You need an ability to really do diligence back doors to understand this. And when I do, so that's on FTX. We passed on that simply on Sam's character. Full stop.
In terms of what? He talked too fast? You didn't feel like he gave documents, or what was it about the character?
The utility of language. I've seen tons of projects. I've been in a space for a very long time. Ability to dismiss risk, speaking fast, thinking that he's the smartest in the room. Just the character-wise, I've dismissed it. That was my own intuition. In terms of the other things that we do, very similar to what Yida mentioned, but I think in addition to that, I'm a little bit tougher. I actually focused heavily on user acquisition, utility, the duration of utilities, the short-term, long-term. As I said, I built payments companies that are really tough to build in these markets, and that's real revenue, real users. 80% of crypto companies don't have users, and they won't have for a very long time. And I think given this market failure right now, it will be hard to build those users going forward until we have some trust. And so I focus heavily on, if the company comes and tells me we are doing partnership with XYZ, I say, great, can you put me in touch with those partners? I'd like to have a call with them. And then you can see who has maybe lied, unfortunately, or maybe misrepresented information. So I'm very careful with my investments on that. But we focus specifically on go-to-market. So if it's a token company, what's the turnaround of that token? What is the valuation? How do they plan to distribute it? What is the utility of that? And if it's on equity and the building of a company, I'm very tough on the utility.
Okay. There definitely are some similarities between journalism and this professional investment world where you're kind of delving into these companies, except in some cases you might have better information. So for both of you, where does the industry go from here? I'm thinking about, after these collapses, we're in this bear market with crypto and with equities and everything else, right? But the implosion of a lot of these crypto firms has gotten people thinking about what needs to change in the industry. So Yida, let's start with you. Where does a VC industry go from here? Are there any changes that you're seeing people starting to make in terms of due diligence or in terms of even, just waiting and seeing and not investing right now, just pulling back? What are you seeing right now?
Yeah, so for Web3 or crypto investing, VC investing, I think there's still a lot of dry powder for funds that raised over the last 12 to 18 months that needs to be deployed. I think a lot of the visitors, the VCs who may be on Sand Hill Road in California, who kind of came in here, bright-eyed, bushy-tailed, wanted to invest in a lot of companies, deploy a lot of capital, got burned, and then have left. And now they're focusing on AI. So I think the investors that are staying in who have been in it for a while are going to be able to do better because the competition is lower now. It's the same true for founders. There's fewer founders in the space relative to last year. And so I think it's great for the investors who have the dry powder, have the conviction to invest in this space during a bear market. So I think it's still going to continue forward in terms of great founders getting funded and being capitalized to take advantage and reap the rewards when the bull market happens again. I think there's going to be more focus on governance. A lot of the investments in the last 18 months were made on SAFs, or simple agreement for future tokens, where there's no voting rights that you're receiving for your investment. And so there's no concept of a board. There's no really downside protection that you have. And so I think going forward, you'll see more, at least safes with token warrants, where you have the convertible note that converts into equity. So you have that downside protection, and then you have the upside of a potential token issuance. I think you'll see more of that and more governance and information rights baked into even seed deals.
Yeah, I agree.
Are you thinking actual examples of that happening already, Yida? Are you actually seeing that happening right now? Or do you just foresee that happening in the next 6 months?
I mean, it has happened in the past. I think it's going to happen more. So I think it's just something, the pendulum has swung from a seller's market to a buyer's market. Investors have a little bit more leverage now and can ask for some of these terms that, frankly, are pretty common in traditional Web2 investing.
Right. Okay. Maja?
Yeah, I agree with everything Yida is saying. No need to repeat that. I'll just add some maybe things that I've thought through in general, VCs, not just in Web3, but in Web2, because a lot of the Web2 VCs have also started investing in Web3, right? I do agree there's a lot of dry powder. So if I go point by point, what Yida talked about, but I do think that we're going to go back to 2-3 year cycles. It's going to decrease of that deployment, right? I think secondaries are becoming really attractive. I know a lot of funds who are looking at secondaries in the crypto space. And I do think that I would urge funds. We are actually consulting one of the funds right now to help them figure out their secondary strategy in the space, because I do think that's interesting. I am very excited about these new wave of startups that are going to emerge during this recession in general, not just in Web3, but in Web2. Because if you think about before, in 2008, right, what emerged after that is Airbnb and Groupon and Uber and all of these amazing companies, right? And so I'm really excited what comes out of this, right? If I see what happened in crypto, all I'm seeing right now is opportunities, right? People come up to me and say, "Oh, are you okay? You're working in crypto." And I said, "No, I couldn't be better," right? This is where the opportunity is right now. To Yida's point, some of these companies that we invested in really need hands-on guidance on how do they actually, right, give those rights, let's say, to equity holders? How do they partner with folks? How do they build a real board, right? How do they talk about strategy and go to market? A lot of them have come into crypto, they're younger, they're in their early 20s, they've never had a job before, or maybe one job, right? So they need a lot of guidance and help through this. I do think in general also MENA region in Asia is going to become more interesting in terms of funding. That's where a lot of capital is going to come from. I do think that the most popular fund size that will be sexiest to the LP investors is going to be kind of between 50 to 300 million. Everything smaller than that or larger than that will be much harder, I believe. But all in all, Kathy, I think, good companies are built in good times and good companies are built in bad times. I think what I'm excited about is this push and pull between we're going into the world where users are going to want more ownership, but they're also going to want more convenience. And that tension between those two things is where I think there's a lot of money to be made.
So Maja, could you expand a little on what you mentioned? You think the fund size between 50 to 300 million is going to be the sweet spot. Why is that? And I wanted to get Yida's input on that too, because I believe your fund, I'm trying to remember from what I've read, invests on a smaller scale, or your VC firm. So Maja, why is that the sweet spot? And Yida, if you could weigh in on this also.
Yeah, I think O Group is partnered with billions of dollars of family offices, and I've seen those people pull back because of macro environment, but also crypto, and they've been slowly learning for years. And I'm also in touch with a number of pension funds who have looked at crypto now and saying we're not touching it until regulation comes out. But I'm also seeing others that say, hey, I like to still play because I do believe in technology. So I like to invest. So they're also seeing this cycle slow down of deployment of capital. And so they're simply not going to, they've specifically told me, we're not interested in funds that are larger than 300 million because it's going to be harder for them to deploy. And they're not interested necessarily in smaller funds because it just doesn't make money for them, right? And those folks probably are not getting as much of an exposure as the others are getting. So I'm gathering my information from those that I work around and the institutional capital that I'm kind of consulting either with or partnering with.
Very interesting, Maja. And Yida, what are your thoughts? What are you seeing?
Yeah, I agree with Maja. I mean, if the fund is too large, there are very few companies, right, like FTX, where you can deploy $200 million into in the crypto space. Especially now, a lot of them have gone away or have significantly downsized, and so you would have to do, if you had a larger fund, you would have to invest in a lot more companies, and that's just harder to manage. As a VC, your value add is not just the capital that you deploy. So it's just harder to manage if you have a larger size of a fund and you have to deploy into smaller checks. And then for the smaller funds, I mean, I think you can do well as well, but you need to be able to, in order to win the best deals, right, to have your term sheet be received. A lot of the best founders have options when they look at investors. And so what can you provide as a smaller fund and lead the deals and do well? I mean, you can be a follow-on investor. I think that works well as well if you have a smaller fund size. So I think there are a lot of great managers who operate smaller funds and can do well because they can provide value, be nimble, and not necessarily have to lead deals, but can get follow-on exposure.
Okay, that's very helpful. I want to read you something that one VC firm, Fred Wilson of Union Square Ventures, said in a blog post this week that, quote, while there are compelling values out there in Web3, I'm not convinced that it is safe to go back into the water just yet unless you have a very strong stomach and a very long time horizon. Yida, you want to respond to that? Would you agree or disagree? I suspect there's more nuance to that. But what do you think of those thoughts?
Yeah, I mean, I think with USV, right, they actually, somebody who worked with us is now working at USV. So I just talked to him recently, and they still focus a lot on crypto, something like 20%, 20-30%. But they're a generalist fund, like other funds out there, and it's opportunity cost. They may think that there are other opportunities in different categories outside of crypto that they should deploy capital into. But as a Web3 native fund, That's all we're focused on. But I do think that, so I'm a little biased, but I do think that there's still, ample amount of opportunity in the space. And we're actually spending a lot of time thinking about incubating companies in this bear market. It's easier to hire talent, top talent. You can have longer runways with the capital that you raise, and there is more time to build, the next unicorns of the next cycle. So there's definitely still a lot of opportunity. We look at developer count in the space, and that really hasn't gone down too much relative to the price of Ethereum or Bitcoin. So I do think that there's still a lot of activity in this space for us to, as investors, deploy capital into.
Okay, Maja, any thoughts on that?
Yeah, I'm just laughing because Yida and I had a call last year, where I hinted at this a little bit. One thing that I've seen, this is my sixth cycle in crypto, and last year in March, I stopped investing, and we're not going to invest probably till May of this year, if not more. And I kind of guessed every single cycle until now in terms of the ups and downs. And one of the things that I kept focusing on last year was on growth and strategy and M&A, and we've had 3 successful exits of the companies. And I kept telling folks that really in funds they should start to, or even partner with us to start really incubating companies and helping them grow because of my experience in Web 2, because I have access to those users in Web 2, and crypto needs users, right? Crypto needs liquidity and it needs users. And a lot of the funds now are coming back to the full circle saying, hey, can we talk now, right? Because I have so much inbound right now of all the crypto companies are saying, where do I get my users? How do I change my strategy? What is my real utility? Who do I partner with? How do I pitch this to Web 2 company, right? How do I pitch it to corporates? Because reality is a lot of corporates right now are looking at Web 3. They have a Web 3 beginning of the strategy, at least. They don't have a full strategy because technology is still not fully maybe for them, or they haven't done the pilots. But I've been there, right? I've been there at GE. I've been there through GE with 7, 8 other Fortune 500 companies, and I've seen that transition. So I do think that that's, to me at least, we have been focused on full-on scale and growth of these companies and helping them kind of succeed and even exit, right? So we have 2 right now that I have in my lap that are wanting to sell and exit with some pretty amazing licenses. And I do think that the TradFi community is starting to look at crypto and where they can scoop up some of these cheap assets.
Maja, and do you think what's happened in the crypto industry and just the general crypto winter, I mean, it's not just crypto, but, all equities and et cetera, but do you think what's happened in the crypto industry is making corporates and the people from Web 2 kind of take a step back and pause? Or are you not seeing that? Are you seeing them rushing in more because of the possibility of picking up distressed assets? I could see both sides of it, but what do you see?
Yeah, I think you're right, Kathy. I can see both sides of it. I've had a couple of lunches now with the folks who are head of digital assets in largest banks and corporates, and they've said both things. They've said, look, we are looking at your industry and seeing where we can scoop up these assets in the future. Look, there's no doubt that the banking industry is completely going to change, right? I do think that we are right now starting to see a dissolvement of the banks going forward in the next 10, 15 years, right? Not that banks won't exist or anything like that. I think that's crazy. But I do think that the payments industry is impossible to keep up with. The technology in the space is impossible to keep up with if you're a large mammoth, right? So I think this definitely corporates are looking at it. If you see the list of corporates that have a metaverse or Web3 strategy, that is probably 20 or 30 of them. Are some of them, let's say even if 50% of them are using it as a buzzword, right, just to gain some marketing traction, fine. But the other 50% is actually hired folks to start thinking about it. And there's no doubt about, if you actually look at kind of things on NFT and ownership and identity, that triage there, I mean, it's fascinating what will happen in the future with some of the social platforms. And then if you look at social platforms and its capabilities to be the on-ramp payments for crypto, I mean, this all we're looking at some massive changes in the next 5 to 10 years, really.
Okay. As I'm listening here, as I'm sitting here listening to both of you, it's interesting because we're talking about the promise in the industry despite what's happened. And I was thinking from the point of view of a startup founder who is maybe watching this podcast, who will be watching this or listening to this podcast and thinking, how do I approach Yida and Maja? How do I get their attention? So talk to me, both of you. Yida, we'll start with you. Which sectors do you see the most promise, and which sectors are you looking at? And if I'm a startup who is watching this podcast, how would I get your attention? And Maja, I'd like you to answer that as well after Yida.
Yeah, I think
no pressure here. But
startups need to be nimble. So what gets me really jazzed up is when a founder tells me, they can reach $1 million, 2 million ARR with $1 million or less. And I think in this bear market, it's founders who can be very scrappy, growth hack, understand UA, use acquisition, understand how to really get a lot with a little, who are going to do well. And so for us, we focus on a couple of verticals right now. As you mentioned, gaming is one category. I think gaming is also fairly counter-cyclical. People in a recession will probably want to play games versus looking at their bank accounts. And I think that's an area that you'll see a lot more activity as the well-funded Web3 games of last year and the year prior finally start to launch. On the other end of the spectrum, we are also very focused on infrastructure, specifically cross-chain infrastructure. There's so many different layer 1 protocols out there today, from Ethereum to the new ones, Aptos and Sui. And so how do you kind of have cross-chain liquidity, cross-chain communication with users and wallets across all of these different protocols? That hasn't been solved yet. Some of the existing cross-chain projects have been hacked for hundreds of millions of dollars. So it's still not a solved problem. And we're super excited to deploy capital into that space, and then also applications that can get built on top of these cross-chain protocols. So two ends of the spectrum that we're focusing on right now.
Okay, and that was very interesting, the thought. I bet that's valuable to people looking for investments, the idea that being scrappy and being able to get a lot of mileage out of little resources, correct? Showing that you can succeed. Okay, Maja, what are you looking for if you're looking at a startup and they want to get your attention? What are you looking for?
Yeah, so I think I do have to give props to Yida, because I know, and he really walks the talk, right? He says that, but he also runs his shop that way. And I know from others internally too, it's an incredible fund and incredible folks internally, super smart, and they really run a tight ship. So he preaches what he does, and I agree with what he just said. I think if I take a step back on this, Kathy, for me is trust is the number one investment, right? And what I say, why do I say that? I think trust, without trust, this industry is not going to get back on its feet very quickly, right? Because they lost the trust with a lot of people. And trust starts with risk management. I will never forget why I didn't invest in Blockify, right? I didn't invest in Blockify because when I said to Zach, hey, you should start hiring risk management, he said, hey, basically, you don't know what you're talking about. We know what we're hiring. We're good at what we're doing, right? And I said, no, you actually need risk management, right? And so custody, ownership, cybersecurity, right? I think all of this for me is really important when I look at a project. And when I look at somebody approaching me, I want to look at everything reasons why it could fail. Because there are thousands of reasons, particularly when founders come to me with so much energy and using word blockchain and all this, and I say, pitch me your product without using the word blockchain. And when they can't do it, I know something is missing, right? And then I have to dig further. So I'm excited about, for example, particularly merchants looking to cut cost transactions. I'm looking at projects like that. I'm looking at projects that could disrupt social media and social media companies kind of looking for new lines of businesses and new ways to maintain kind of their interest in their platforms through these projects. I'm looking at projects that are going to alert larger customer engagement, and I'm looking at projects and tech that can loop into some social media platforms that can make him, as I said earlier, on-ramp platforms. ZK, as I think Yida mentioned, NFTs. I'm looking at all of that at the moment for sure. And then I'm looking at fully on-chain games or autonomous worlds. And the last thing I'm really interested in, because I did early pilots in 2015 at GE, I'm very interested in decentralized energy. I think that that's really gaining traction in a lot of places. I've done it super early. Nobody was doing it at the time. I was actually the first one in the world that we did these pilots on decentralized energy, and we tried it. But I do think this is something that is grabbing my attention. It's a real world use case.
Okay, fantastic. So we have time for one more question. Yida, sometimes this ends up being the most interesting part of the broadcast, and I try to end with this question. What's one thing I did not ask you today that you think is important and that you think people should know about the industry and about what you do?
Great question.
I know that's a tough one. Basically, I'm sure there are many areas, but what's one thing that you think is important that?
I think one thing that keeps me waking up every day, jumping out of bed, is how quickly this industry changes. And for the folks who are reading the media, listening to the news, and seeing all these crazy things about fraud, FTX, the SEC regulations, et cetera, that definitely has gotten bigger now, because luckily the industry is getting larger and more eyeballs are on it. But that's not those aren't things that a lot of investors, especially people on my team, are really focused on. We're focused on making sure that we can support our existing portfolio companies, helping them manage this winter, and maybe making adjustments to business model if necessary, and focusing on outbounds of connecting with founders who are building cool things in the space. People in Web3 create Twitter accounts before they create LLCs. So we spend a lot of time on Twitter, and I think that's another thing that has been in the news a lot. And for us, it's not just a source of entertainment and gossip, but it's actually a good tool to source deal flow. So I think I would just leave this conversation with the thought that the space is ever changing. Maja knows it, being in so many different cycles, and we're still in it after so many different cycles, because we know that the next high will be higher than the recent high we had. So I think for us, we're just really focused on keeping heads down and building.
Okay, and Yida, just to follow up on one thing you said, when you talked about hand-holding with some of your firms, are we talking about making introductions to them, helping them define their business strategy? Like, how much hand-holding do you do as a VC firm?
It depends on the company, and it depends on the founder. But from where we sit, I think one of the responsibilities of a VC is to help their companies with whatever they need. Be the janitor, wear a lot of different hats. And some companies need help financing, helping raise subsequent rounds of financing. Other companies need help with product. Other companies need intros to exchanges or to partners. We have a lot of portfolio companies, so we can do a lot of cross-portfolio business development support. So I think it's everything. It just depends on the company.
Yeah, and I think it's really interesting that Shima Capital also is backed by all these names. It's kind of like this circle, right? Shima is backed by Animoca, OKX, and even actresses and others. So very, very interesting. Maja, what's one thing that I did not ask you that you think it's important for the VC industry to know or for startup founders to know?
I don't know. One thing, you're pretty thorough, but I think one thing for I think anybody watching or in the future watching this podcast, we really are focused on the growth, everything from helping the founders really pitch to grown-ups, shall I say, because a lot of these, unfortunately, founders are younger, which is great. It brings us new ideas and fresh ideas, but I think we've got to understand who we're pitching to. So we help everything from that to we have a small incubator and we help grow scale, but we also are more and more focusing on M&A advisory. So that's really, I love doing that. I've been doing that all my life and I enjoy it very much. And I've lived in 5 different continents. So for me, it's really easy to navigate a product globally. One thing that I can leave everybody with is that, crypto has such a great potential to change everybody's life. It's changed mine. It's changed, a lot of people's lives. And I think in the next few years, the biggest challenge will be how to unlock the benefits of this technology and crypto while also kind of balancing the real risks that this technology poses, right? Blockchain can be good and bad, right? Crypto, as we've seen, can be prone to scammers and really leaving some people in a debt spiral, and it can be misused. So I think I think there's a lot of responsibility on VCs. There are a lot of responsibilities on regulators. There's a lot of responsibility for those of us who have been in this space for a while to advocate a good utility of this technology. And last thing I will say that crypto is based on math, not politics. Therefore, I'm sticking to it.
Okay, well, this has been very fascinating. I hope you both will come back and talk to us sometime soon. That's it for this edition of Crypto Defined. Please check out TruthDAO.news in the next few days for a written recap of our conversation with Yida Gao and Maja Vujinovic. Thank you both. I really appreciate it.